Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld, and we're here for a special Wednesday edition of
Post-Memorial Day.
Post-Memorial Day.
Lots of news, though.
Lots of news, so let's get to it. The biggest stories right now in the more than $15 trillion global ETF industry. We start with 30-year Treasury yields rising on the day, touching almost 5%. In just a moment, we'll speak to Alex Morris of FM Investments on this big move in bonds and why investors continue to just pour money into Treasury ETFs.
Trump media making a push into ETFs with offerings tied to the president's agenda right as the company gets ready to buy Bitcoin.
And as leverage ETFs gain in popularity, we'll speak to Sylvia Jablonski on the fund that invests in the company that's known as the NVIDIA of quantum computing. NVIDIA itself reports after the bell today. But as always, before we get to all of that, Eric Balchunas, I just remembered his name, from Bloomberg Intelligence, is here with us now, looking at the flows. What do you have, Eric Balchunas?
It was a long 10 days, Katie. I know. Scarlett, thank you. So, look, we're looking at an oddball here at the top. IAGG, what's that? That's International Ag. So international bonds, this is probably a BlackRock model rotation. So they're liking the international bond world. IBIT, interesting. This is on a tear. This thing has been gobbling up Bitcoin like crazy. $9 billion in 6 weeks total. So second only to VU, who, by the way, took a week off. VU is almost always on this list. It's okay, it deserves it. Still $64 billion year to date. But IBIT and VU, again, we're back to that beta with the side of Bitcoin this year. But we're also seeing, as Katie mentioned, people buying treasuries, TLT, particularly the long end of the curve. A lot of flows into TLT, more Qs there. So again, pretty much like 2024, to be honest with you. Let's look at the outflows. Some money coming off the table in SPY. Speaking of 2024, poor small caps. They can't get going again. Money coming out of those. And then this is interesting, EMXC, emerging markets ex-China. So $1 billion out of that. It was a huge trade for a couple of years there. Let's look at the U.S. fixed income. You know, Moody's downgraded the U.S. There was all this crying over the U.S. and whether people were going to pull their money out of the market. But at least with ETF investors, this is U.S. fixed income ETFs monthly flows historically. In May, we're already at $28 billion. So, like, look, that's the doubling the last 2 months. And if you go back, it's, you know, easily a top 10 month. It's not even over. We could have a top 2 or 3 month, Katie, in U.S. fixed income ETFs. So nobody really caring about, you know, yields creeping up or the Moody's downgrade.
Yes, a lot of crying, but still a lot of buying. Eric, thank you. Perfect setup for our conversation with Alex Morris. He is the CEO of FM Investments. We have a lot to get to, but let's talk with that bid into bonds. Eric just showed us that great chart. And also, when you take a look at TLT, that is the iShares 20-year plus Treasury ETF, taking in billions of dollars over the past couple weeks. And for some, this has been a widowmaker trade. It feels like yields, long end yields in particular, have just been on a roller coaster. So how do you explain just this off the charts demand still for long end bonds in particular?
Well, Katie, it's good to be back. And yeah, I think we've always talked about the fact that folks really love the Treasury market. It's a great yield. There seems to be an insatiable demand when long bonds and the 10-year bond hits 5%. And folks are there to just keep hoovering them up. Early on, we saw a lot of yield hunters as rates went up, and they loved the short end. They still do. And we see flows, strong flows still across the board. But now, as rates hit 5%, I think investors have priced in a non-AAA rated U.S. for a long time, and they're happy to absorb those 5% yields and roll those forward in their portfolios.
How are investors thinking about that 5% level when they look at what's happening globally? We've seen yields in Germany and in Japan on the long end move higher, creep higher, yield curve steepening as well. I mean, putting it into context, what's the picture that really gives us?
Well, I think global treasuries have been on a different ride than the U.S. for a long time. The BOJ was pegging the 10-year Japanese bond to the 10-year Treasury for a long time. That stopped last year, and we saw some movement for the first time in a long time. Germany made very clear they're going to start spending aggressively, largely on defense. So we're seeing different dynamics that are really causing global sovereign rates to behave more like what the U.S. was used to, which was a more volatile, slightly higher interest rate environment. And it's probably good for global bond investors to see yields outside of just the U.S. But clearly, U.S. ETF investors still buying U.S. Treasuries everywhere on the curve as much as they can get.
Alex, it's Eric here. Can you explain this concept of buying TLT? It's yielding 5%, but you can get almost the same yield in a money market fund or the short end of the curve. SGov is a big flow getter this year. It looks like it's 4.7%. I mean, why bother with the duration risk? Is this just a bet on the Fed, or what's going on here?
Well, I think there's a couple of dynamics. First, TLT's got a lot of interesting convexity in it. You can get more pure play through UTWY, UTHY, where now you are looking at what are rates going to do. And there is a lot of optimism that rates will need to come down at some point, and that duration is going to be very attractive. Obviously, you're not going to get that on the short end. You're just going to get your cash on a more regular basis. It's a different risk trade. But I do think you're seeing a lot of folks who are looking at the attractiveness of rates are unlikely to go up. The Fed has a message of we're not reducing them anytime soon, but they will be reduced. And you're going to get a pretty nice kicker on a 30-year bond that you're just not going to get on a 30-day bond.
I hear what you're saying, but to Eric's point, I take a look at your own lineup and where all the money is going. T-bill continues to be your most popular product. Of course, you take a look at what that tracks, and it's 3-month Treasury bills. That ETF has taken in about $1.2 billion year to date. So I get the case for why you would be interested in the short end. I hear what you're saying about the long end and the opportunity you could get from the duration there. What about the middle of the curve? Does anyone care about what's going on sort of in the belly?
It's funny, the belly of the curve is where a lot of the action should be, and we're seeing folks start to venture out to that, whether it's 2s, 3s, or 5s, but we just haven't seen the response yet. And it's hard to blame the average investor or advisor who looks at a 4% plus yield on a 90-day risk-free rate security. Why would you take that risk yet? And if you're going to take some risk, the appetite seems to be, I want to take a lot more risk, and we see that barbell. We also recently came out with our bill where folks who said, I really like the 90-day, but I now want some inflation protection because I'm worried. And I think that's going to continue to gain some speed as investors look beyond just the pure short-end Treasury market. But that said, if you don't have a better idea, T-bill and chill. Worked last year, worked the year before, still works.
It's the mantra. Let me ask you about the 5-year and the 7-year. We have a $70 billion auction of 5-year bonds later on today in about 30 minutes, 45 minutes or so. And then, of course, 7-year auction tomorrow. We're at a point where everyone is so fixated on each auction result. What does that say about people's confidence in treasuries right now?
Well, I think the fact that folks are focusing on the auction is a good thing. For a long while, we just took it for granted that the auctions were largely oversubscribed. They were a footnote that hit the terminal. But we do need to care, because how we fund the government and how we think about managing our debt long term is a really important thing for investors to look at. That said, there's been a lot of concerns going to these auctions, but they're rarely, if ever, fully validated. It turns out there still is a lot of demand for these securities. The government and the Treasury Department, as they reissue debt to the longer end of the curve, hasn't flooded in the market yet. And it's been a kind of orderly push away from ultra short end into the belly of the curve. And investors have responded well to that. And I think we're going to see that in the next 2 days in the next 2 auctions.
Alex, let's talk a little bit about your interesting filing. Most of these asset managers are filing ETF share classes of their mutual funds. You, however, an ETF issuer, are filing a mutual fund class for your ETFs, presumably to get into retirement plans. What can you tell us about that? And where's the SEC on approving all these? Could we see all these both ways coming out in the next few months?
Yeah, so you're absolutely right, Eric. We wanted to get access to the retirement market, but also to give folks in the retirement market who are largely shut out of much of the innovation that ETFs have brought to the market access to those much needed investment tools. Now, the applications have kind of merged where it's clear that a mutual fund of an ETF and an ETF of a mutual fund are going to be one and the same. And we think that's a good thing. The ability to convert from a mutual fund to an ETF is also a positive thing. The SEC has been working with us and other issuers, been a great partner in this process to make this happen. I think many folks were hoping it would happen by the end of May. It seems like it's going to be a Q3 item, as there's a lot of operationalization of this that needs to happen, both from the regulatory level, but also from the individual issuer level. And although there's 53 filers who asked for this relief and almost all 53 have refiled, I don't think on day one you're going to see an immediate rush of thousands of ETF share classes of legacy mutual funds come to market. You'll see folks like us who've been leading the way because we think it's a necessary tool. We're going to continue to do that because it's good for investors. But I think you're going to see a lot of the folks who had a little bit of FOMO filing for mutual fund ETF share class relief. We're going to sit on the sidelines for a while and kind of let us work out How do we operationalize this? How do investors absorb this? And what does it mean to run an ETF business alongside a mutual fund business? Because there are two separate ways of thinking.
Absolutely. We'll continue to keep an eye on that storyline. I'm sure we'll be talking about it with you again soon. That is Alex Morris of FM Investments. Now, coming up, as Trump media prepares to raise $2.5 billion to buy Bitcoin, it also makes a move to push into ETFs. We'll discuss next. This is ETF IQ on Bloomberg. All right, welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with State Street, at it again, filing for a second private credit ETF, of course, being sourced by Apollo once again. This just a couple weeks, a few months after they launched their first private credit ETF, ticker PRIV, which has struggled to gain momentum. This one is slightly different. It'll also focus on public and private credit. It'll focus specifically on shorter duration assets, though. Excited to see this one get off the ground. But let's also talk about fees on new funds. This is a fascinating chart. You can see that the average fee on new U.S. listed ETFs has continued to climb, now hanging out around 65 basis points. We talk all the time about the appetite that we're seeing for active ETFs, both from investors and from issuers. And as a result, you're seeing the average fee tick higher, since active funds tend to cost a little bit more. So it'll be fun to watch that line move. But let's end, Scarlett, with Trump media. Of course, this is owned by President Donald Trump, pushing into ETFs. They've talked about plans to sell investment funds tied to Donald Trump's agenda, including ETFs and separately managed accounts. There's been no public filings available yet, but theoretically, this is coming.
Theoretically, it is coming. So let's bring in Bloomberg's Vildana Hajric, who's been writing about it. Vildana, is this something that people in the ETF universe are talking actively about? The, President Trump expanding his universe to ETFs?
I think people in the politics universe are maybe talking about it a bit more, just because of, the optics of this, meaning, maybe you are gaining access to the White House or the presidency in some way. If there are actually ETFs tied to the president or tied to one of the president's companies, there's also within the ETF universe the issue that there's so many competitor products already. So you already have more than 60 oil and gas and coal ETFs, for example. You have more than 60 Bitcoin tied ETFs, and those are two of the three themes that the president's media company is suggesting that they're going to be filing and launching. The third one being cryptocurrency, the Made in America theme. So we have cryptocurrencies made in America and oil and gas.
Right.
And so there are competing products already out there, meaning that for those issuers who are behind those funds, they might not have the advantage that the president's ETFs potentially might have, which is the president being out and about and potentially talking about the products or promoting them.
So then what is the differentiation factor here? Is it just that you have President Donald Trump's brand attached to these ETFs, which would theoretically be launching, as you say, into a very saturated market?
Yes, a very saturated market. Potentially, that is one of the differentiating issues there. But what some ethics experts have said to me is that, again, coming back to the optics of this, is that the president can enact policies that benefit the funds that might not be beneficial to everybody else, for example. So maybe he'll be devoting a lot of energy and a lot of his time to enacting policies that will help these ETFs. And also, they're saying that they'd like to launch separately managed accounts as well. And so that's one of the issues that certainly is being brought up by people in the industry, but also people outside the industry and people in the politics universe, as we just said.
All right, Vildana, thank you so much. Bloomberg News' Vildana Hajric. Of course, these are just plans right now. That we have not yet seen a filing to the SEC. All right, still ahead on ETF IQ, we drill down into a leveraged quantum computing ETF with Sylvia Jablonski of Defiance ETFs next. And a reminder, you can listen to Eric and Joel Weber on Trillions, their podcast that covers the industry. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence back with us now for today's drill down, where we focus on one ETF. Eric, hit it.
Katie, today we had sort of a 1-2 punch. Last week we covered QBTX, which was this sort of hotshot 2x quantum computing stock ETF that was just going wild with volume and return. Now it has a sort of a brother, a competitor, 2x IonQ, which is, again, another hotshot quantum computing stock. As Katie said, wants to be the NVIDIA of quantum computing. Now you can get 2x. This thing just came out a couple months ago. 1.3% is the fee, 55 million. Let's look at the volatility. So this is all ETFs ranked by 10-day volatility. So this is the hottest of the hot sauce here. This is ghost pepper level. To me, anything over 250% is what I would call biblical volatility, right? This is like, it's going to go up and down 40% sometimes every day, sometimes 80, 90%. Anyway, you got multiple ETFs here. This is the one we're talking about today. QBTX still a little more volatile, but all these, get this, are about double the volatility of the 2X MicroStrategy ETF. All right, let's look at the returns of this. I threw in a couple other things just so you can get an idea of just how tremendous the returns are in only like 2 months. IONX is here. This is the ETF we're talking about. That's the stock. That is the S&P, and that's Bitcoin, which has been on a tear. But like, this is a whole nother level. So Katie, the hot sauce is here, and the degens are responding. Both these things are trading over $100 million a day.
Eric, thank you. Joining us to talk about this ETF, I'm pleased to say we have Sylvia Jablonski. She is the CEO and CIO of Defiance ETF. Sylvia, great to have you in person with us. I feel like I learn about a lot of different companies by just looking at what has a leveraged ETF launched on top of it. And just starting high level here, I'm curious how you find the companies that you launch leveraged ETFs on. When it comes to an IonQ, did you find that by just filtering for the most volatile stock, or what is the selection process?
Well, first, thanks for having me. And as Eric said, it's hot sauce, right? And short-term tactical traders love hot sauce. But the way we look at this is, we see AI as the fourth, the leader of the fourth industrial revolution. And then after AI, what comes next? Well, that's quantum computing. You're talking about a market that is going to grow at a 40% compounded annual growth rate, and there are leaders in that market. And so what is the most pure play quantum stock out there? It's actually IonQ. It's the first publicly listed IPO pure play quantum stock out there. It's the most highly traded. It's been on quite a tear. It's the first company that's kind of bringing in positive revenues and getting itself to a level of profitability faster than the other companies. And it's really, as the CEO said, the NVIDIA of quantum computing. And so we thought that traders would like this in a 2X.
And thank you for giving us the fundamental case for the company as well. That was my next question.
Yes.
I'm curious, how would traders, especially those on the institutional side, like the hedge fund guys, for instance, use this leveraged single stock ETF versus, say, retail investors?
Yeah, so I think, with institutional traders, a lot of times they're a little bit more savvy and they kind of have this as a model-driven type of trade on their side, right? So they think that there will be a trend for a certain amount of time, and so they want to amplify their exposure to the underlying stock, in this case with the 2X. And so they'll hold it until they think that that trend is going to essentially collapse or perhaps move into a volatile market, and they'll kind of trade in and out of it. Retail, it varies. Like, if you look at the data on levered ETFs, a lot of retail traders are still continuing to trade these pretty actively within a 1 or 2 day period, which is actually what they're intended for and is somewhat reassuring. Of course, when you see charts like this, and I mean, we've talked about this, all three of us, for years, the 3X tech ETFs and the semiconductor ETFs that were leveraged for that decade that the market was going up, you had stellar returns, right? So it's just all about the volatility, the trend, and the holding period is dictated by those two things.
So we had your competitor on last week, QBTX, and we asked them honestly, okay, what could happen for this thing to terminate, right? Because when you're dealing with this much volatility, it's possible, like, let's say this stock has some crazy issue that's just horrible, right? The stock declines, how much would the ETF then have to sort of like call it a day and liquidate?
Yeah, so I mean, it's hard. It's kind of hard to answer those questions, right? Because like we saw that with Supermicro at some point, right? There was this period of time where they hadn't filed their financial statements, and the stock was falling, 25, 30%, and things like this. And obviously, that leads to exacerbated drops in the levered ETF itself. But levered ETF issuers, like we have different safety nets in place. We have conversations with the SEC, with the exchange that we're listed on, and things like that. So at some point, like if you wouldn't create an ETF if you thought it was, for example, going to liquidate, but there's kind of a really long runway before something like that happens. You'd have to have close to a 50% drop in the stock itself to wipe it out. So
I want to talk about the concept of double short, the double short trade. I know that you have a filing out there, and I won't ask specifically about that, but the concept is basically that you bet against both leverage long and leverage short ETFs, and the idea is that because of the reset, because of the volatility decay, both of those will go down over time, and if you're betting against that, then you'll profit. So it's interesting to see this maybe be worked into the ETF wrapper. Plenty of hedge funds do this on their own, such as Rob Arnott. But there is this concern out there that if it is launched in the ETF wrapper, then the trade basically will cease to exist when you think about how expensive it'll become to short some of these products. And I just wonder what your high-level thoughts on the concept are.
Yeah, and that was a great article that you put out on that piece. And so I think that, I've been in ETFs for a long time, and one really cool thing about ETFs now is that they have evolved and come to a point where the retail community gets this democratization of products in an ETF wrapper that they can easily trade, and I think that's what the double short ETF could do. In terms of the borrow is going to be expensive if the stock is highly volatile, if the stock is falling. It's not necessarily because people are going to be scooping up the double short ETF, right? So I think it's more about the volatility of the underlying. And if anything, I think that the bigger that these things you get these create to lend facilities, and actually the borrow becomes more appealing in that form. So remains to be seen, but yeah, the borrow will dictate what the returns look like, right? If the borrow is too high, returns will be lower.
And I have to ask about the one you have filed. I think it's around time that it's going to be due to come out, which is the 2X hot sauce ETF. They named it after our moniker on the show here. This is going to hold 5 to 20 of the most volatile stocks in the market. What's going on there? Do you think this thing will make it to market? And
in like 15 seconds.
Yeah, we can't talk about products that are not yet effective, but there's a lot of them on the list there, whether it's Trillions, Hot Sauce, Pure Quantum, the double short. You'll have to see what's next.
All right, the clock saved you here. Sylvia, it's great to see you. That is Sylvia Jablonski of Defiance ETFs. And you can read about this drill down, plus the latest in the ETF industry when you subscribe to my weekly ETF IQ newsletter. But that does it for Bloomberg ETF IQ, the TV show. I'm Katie Greifeld alongside Scarlett Fu and Eric Balchunas, and this is Bloomberg.